Kick off?
Yes, please.
Okay. Well, good morning, everyone. It's a beautiful Thursday, the 28th, and we are very much looking forward, have been very much looking forward to this session this morning. As we have been talking among ourselves, I don't think we could have a more interesting and appropriate set of presenters, panelists this morning to take us through some thinking around our current situation. But let me kick off by welcoming members and guests of the Business Alliance and CBD Sydney Chamber. We do this as a partnership, a collaborative activity, and we've been running these sessions now for about the last 8 weeks. And we've had a tremendous response, and we've got a lot of exciting stuff that's planned for weeks to come. Might just remind you that we've also got, because you're probably all quite used to using Zoom by now, but we do have that chat opportunity that you can click into. So if you have a question that you think you might want to talk about when we get into the Q&A, please feel free to pop it into the chat section. If you want to connect to anybody in the group, you can chat with people individually, so please feel free to do that. We're going to kick off with some presentations and some discussion with Felicity and Bruce, and then we are going to go into a Q&A session where we can ask questions. So we look forward to that. And then we'll follow that up with some introductions among our members, and also then a little virtual networking, which we can talk a little bit more about in terms of how we'll do that. So we aim to be finished by around about 11:30, unless you're a very chatty group, in which case we can extend beyond that. But I would like to kick off. Sorry, Dimitri, before we introduce our speakers, would you like to say a few words?
Yes, definitely. Thank you, Peter, and good morning, everyone, again, and welcome to another great event we put together in collaboration with the CBD Sydney Business Chamber. Where, my name is Dimitri Greco. If some of you don't know, I run Business Alliance New South Wales. It was a slight adjustment without big launch from Business Alliance to Business Alliance New South Wales to make it more clear what we do and where we work. And also the BusyNet magazine, which I believe you all, or almost all of you received in mail just recently. And as always at our traditional face-to-face networking events, and the same formula we apply to our virtual networking events on Thursdays, I would like to say thank you to our main supporters and our main contributors who are City of Ryde, the Hillshire Council, Arthritis New South Wales, Joyce here this morning. They are our charity of choice. Pretium Solutions, ATN Lawyers, John's Partners Insolvency and Recovery, and two of our great members there also, Preferred Supplier, Mytronics, Preferred Supplier in office equipment and printing equipment, and Australian phone company, Preferred Supplier in telecommunications. So thank you all for supporting us, and thank you all for being here this morning. Yes, Peter, back to you, and we should start with our presentation.
Okay, can I just, we have one person who's trying to connect, and I'll come to her in just a second and see if we can't get her organised. Okay, well, I would like to kick off by saying thank you very much to, from a CBD Sydney Chamber perspective, our sponsor, ANZ Bank, and I would like to welcome both Catherine Problet, who is our key contact in the bank. Catherine is there. Thank you very much. Thank you for facilitating having Felicity with us this morning. Felicity is Senior Economist with the ANZ Bank. We're really looking forward to this conversation, I have to tell you, because We had the privilege of having Felicity chat with us. I think it was June 2019 at 20 Martin Place, and she gave us a very interesting perspective on the economy as it was then. I think a few things have changed since then, so that should be interesting. I'm also delighted that we have Bruce Gleeson, who's Principal of Jones Partners, Insolvency and Business Recovery, and surely I suppose that must be a topic that many businesses are thinking about, and we are also reading a lot about it in terms of the current environment and what may follow. So without further ado, I'd like to hand over to Felicity. Welcome, and we're looking forward to it.
Thank you, Peter. So everyone, I assume everyone can see the screen there and my slides. You can't
see slides yet, Felicity.
You can't see the slides.
No, we're seeing lots of faces.
Right.
Felicity, could you put it back on your presentation?
There we are.
Yeah.
That's working?
That's
all good.
Great. Great. Okay. So thank you very much, Peter. Yes, June last year seems a very long time ago now. Things have changed quite a lot since then. But that event was very good. It was great to speak to all those people, and the interest in the room and the questions were really interesting for me. So I'm looking forward to all your questions at the end of this. The title of the slide pack there today is called Moving into the Easing Phase, the outlook after COVID-19 in a COVID-19 world. And we're obviously going through a very difficult period right now. We're right in the midst of it, and then sort of looking out to the other side. So some of the slides I'll go through is the going into the phase, the COVID, some of the health slides, and then what we're expecting over the next 12 months or so, with a little bit of extra focus on the housing market, because that is such an important driver of the economy. So I'll kick off now. The first slide there that you can see just shows the daily cases. Now I've deliberately put them on two charts, because if I put the world and the US on the same chart as Australia, you can't even see Australia. And that just goes to show how well we've done. Even as a small country, even per population, we've done incredibly well. So we really hit the crisis, broadly around the same time as the US. We got to our 100th case in early March, just a few days after the US, obviously after China, after Italy. But you can see there how quickly the cases ramped up. And at that point there, that late March point, which is the peak of the curve, is the time when Treasury were doing their forecast and pulling together the JobKeeper program. We also were pulling together our forecast. We had, lots of commentary in the paper that, very shortly our health system would be overwhelmed, as was the case in Italy. So it was really, peak terrible there in late March. And so, but we really managed to reduce those cases very, very quickly. So if we look on the next slide, this shows the Oxford Stringency Index. So this is an index that compares government lockdown measures that have been put in place to flatten the curve in different countries. So when you get to 100, that means everything is closed, and at 0, everything is open. So you can see there, China was obviously the first to move in locking down its economy in response to the virus. But I've only chosen a few countries there, but we were very early to make those first steps in initially closing the borders to anyone who traveled through China, and then, subsequently a few other countries like Iran and Italy, and then by late March we'd really fully closed our borders to any foreign nationals, and that was incredibly helpful for us. And we have obviously had a big advantage because we were an island nation. But when you look still now at our cases, we're still, you know, around 60% of cases are from overseas, and the rest local transmission. So it has been that locking the borders early was really helpful. When you look in comparison now, we've sort of been about middle of the pack. Now that New Zealand has opened after their very stringent restrictions, we're looking a bit tight, but things are obviously changing very quickly. Sweden down the bottom there, with a, you know, what's been famously seen as relatively lax lockdowns there, which doesn't really seem to be working in its favour. So we have had quite strict lockdowns, but it was really those early border closures that gave us that advantage and helped us bring the daily cases down so quickly. So because of these lockdowns and because of the virus, you know, we can't, there's a lot of commentary in the paper suggesting that there is this trade-off. You either have a health crisis or you have an economic crisis. It doesn't work like that. And you can see in lots of countries, like for instance, Sweden, where they didn't actually have much of a government sanctioned lockdown, people still stayed at home and they are still having these, you know, quite you know, big falls in their economic data like retail sales and the like. So there wasn't, you know, people will not go out if they're worried they're going to be sick. So there isn't really this trade-off that some people are suggesting. But these numbers here I have here are IMF numbers for growth projections. And you can see there for the globe, looking at down 3% for 2020 with a big rebound, 6% in 2021. Advanced economies decline is much sharper in 2020 and the recovery not so strong. But I'd be really careful in interpreting these numbers. The next slide shows ANZ's own forecast, and you know, they're not really sort of too different from the IMF. You see there the US, we've got down 5.5 in 2020 up to. In Australia, for example, we've got down 4.7 this year and up 4.1 next year. But I'd be really, when you look at these numbers, you sort of look at some of them and you go, well, that looks like a V-shaped recovery. You know, we're down quite sharply, then up quite sharply the next year. But when you look at actually the level of GDP, that is not really the case. You know, if you think about it just in sort of, I'll just give a quick example of maths terms. You know, if your level of GDP is 10, it falls by 50%, it goes to 5. And then the next year it rises by 50%, it goes to 7.5. You're a long way below that initial level. And this is going to be the case with GDP, with employment, with retail sales, is that you're going to see this very large decline in Q2 when economies were shut and people were voluntarily and involuntarily staying at home and not spending. And then what we'll see is we will see as things open up, things will get a lot better quite quickly, but it will take a long time to get back to the sort of level of activity that we saw before we went into this crisis. So in Australia, we don't expect to get back to the level of GDP or the level of employment that we had in Q4 2019, December, at the end of last year, until 2022. So it's going to be like quite a long grind out of this hole that we're in. I would say though, particularly in regard to those forecasts for Australia, as I said before, we made our forecasts in late March at the peak of the sort of disaster news, and things have turned out both on the health front and possibly, although it's a bit early to say, on the economics front. So the risk certainly to our forecast is that things will be a little bit better than we had earlier expected. So the next chart I've got there shows some market prices. We can see markets really struggled initially to price what was happening. But it does seem as though the markets are thinking that now we are sort of past the worst. We had another strong rally in the equity markets overnight, certainly helped by an announcement of big fiscal stimulus in Europe. And we are seeing improvements on a number of metrics around markets. But again, they remain, well, if you look at the equity markets, remain well below where they started off. So the next couple of slides, I've just got some points on the measures that have been implemented to support the economy. And in Australia, once again, the policymakers have really stepped in very, very quickly to support the economy. You know, we have, I think, the largest fiscal stimulus of all the major economies. The numbers out of Europe last night suggest they might be getting a bit bigger, but we are, with all the policies that the government has introduced, it's very significant stimulus. On the monetary side, it's a little bit different this time round. So the RBA was able to cut the cash rate by twice by 25 basis points, so total 50 basis points. This is a little bit different to the global financial crisis when they cut rates 425 basis points over a period of a few months. They don't have the same ammunition that they had then. They have introduced some unconventional measures, and they've introduced a yield curve control policy where they keep the 3-year government bond yield at 0.25. So it helps to keep a lot of rates lower, and it helps to anchor expectations that rates will stay low for some time. And they've also provided some funding facilities to help small business and injected liquidity to keep the market really moving and working properly so that we don't have any dislocations in financial markets. And obviously we've had the banks offer this 6-month home loan or loan repayment deferral for both home loans and small business loans. So that has been important as well. And on the fiscal front, we've had a number of packages. You know, the government rolled out the first package for essentially for businesses to stay open. Then they announced some of those welfare payments for people on different benefits. So that was quite a significant measure, $750 for anyone on any of those sort of family tax benefits or Centrelink benefits. So that was quite widespread. And then the JobKeeper. So 130 billion in the initial announcement. Obviously, that's been revised down recently. Now, I know there's a lot of criticism of the Treasury around this, and you know, I'm sure if it was Labor that the Libs would be attacking them as well. But as I said, you know, it's an extraordinarily difficult time, and forecasting in this environment is so difficult. I just think they were at a point in time where they really thought things could have got really bad, and they were willing to spend this money to support the economy. And the way this JobKeeper package works, it really is a safety net for the economy. And so I think it's great that they don't need it, and it means that there might be a little bit more that the government's willing to spend to extend that further down the track. But all those measures are really very significant in supporting the economy, and will help to minimise the job losses. And that's really what they want to do, because it's those job losses and that disconnection from the labour market that really makes it much more difficult to recover. So going into this crisis, GDP was not really firing on all cylinders, you know, and this is something actually I did speak about in June last year, is that, you know, a lot of the growth was driven by public sector spending or exports. In this chart here, you can see private sector demand is actually pretty flat and had been for some time. So that was largely, or not, well, a lot of that was around the weakness in the housing market. So house prices fell between mid-17 and mid-2019, and that fed through into housing construction. We also had falling business investment, and because of the weakness in house prices, we had this reduction in consumer spending growth as well. Low income growth was also a factor there, but the decline in house prices probably accounted for half of the decline in consumer spending growth. And keep in mind, consumer spending is worth about 55% of our economy. So we had this sort of broad-based weakness in the private sector already going into this crisis. In late 2019, having had house prices recover for the previous 6 months, we really thought 2020 was going to look quite a lot better, that consumer spending would pick up, housing construction would pick up, and the outlook for business investment was also improving. So the economy really has panned out quite differently to what we expected. So the next few charts, I'll just talk about these initial effects that we've seen from the coronavirus. And this one here shows the decline in consumer confidence. This is our weekly ANZ Roy Morgan chart. We get a very up-to-date view on consumer confidence. I mean, it did start to decline in December, January with the bushfires, but then it really collapsed with the COVID-19 news. We have seen over the past few weeks a gradual improvement over time. It's still well below average, and certainly suggesting that consumers remain quite worried about the future, but it is well off those extraordinary lows that we saw a couple of months ago. Business confidence and conditions have also deteriorated quite sharply, but interestingly, once again, the confidence measure here has picked up in the latest survey. So really, and this is something that the RBA governor has spoken about, really confidence is so important in the recovery. And if we continue to see that improvement in confidence, both on the business side and on the consumer side, then we're much more likely to see spending continue. And on that front, retail sales declined nearly 18% in April, after a big rise in March around the panic buying. So this really reflects the lockdown as well as the reversal of that panic buying. And when we look at our ANZ data, it suggests that things are starting to pick up from here. But April really is looking like the worst month in terms of activity, wages, employment, those sorts of things. And here, this shows that exactly. And this is a really interesting chart, this one. So this is actually special data that the ABS is producing at the moment to stay on top of what's happening and get very up-to-date data. So they're working with the ATO to get numbers from the ATO on jobs and wages. So this chart shows a split across industries. It shows the decline in jobs and wages for the period between the 14th of March and the 18th of April. So there's a couple of interesting things that I'd point out in this chart. First of all, you can see, not surprisingly, that it's the hospitality sector that's hardest hit. Jobs down over 30%, wages down about 30%. Arts and recreation next hardest hit. But the other point I'd make here is that this covers all the industries, I think, except, oh no, they've got agriculture. So I think there's about 17 industries there. Every single industry saw a decline in wages and a decline in jobs. This decline in activity is not isolated to the hospitality sector. It is very broad-based. You can see there in finance, wages down 10% or so. Retail, obviously, construction remained fully open the whole time. So we're already seeing this coming through across all sorts of industries. There's lots of GPs saying nobody's coming in. There's dentists that had to close, chiropractors that have to close. Like, so even in the health sector, you've had an impact. In professional services, lots of the big consultancies have moved to 4-day weeks, quite significant impact on wages there. So this is not something that is narrowly based in that one sector. It is affecting people from all different sectors, and that will be important for the recovery as well. Now, since we have had another lot of data since this one, and it does show a pickup. It incorporates JobKeeper, because JobKeeper the government started to pay JobKeeper in early May, and so we have seen an improvement there. So that is really encouraging, and it also shows how important JobKeeper is in keeping these wages up, so people can continue to spend, and so they remain connected with their employer. And also, since we've started opening up, we're starting to see people moving around a bit. So this is a chart from Apple Maps, and it shows, how much routing there is. You can see there the very sharp decline, and then the pickup now. Lots of pickup on driving, not so much on public transport, which is what you would expect. But we are certainly starting to see people coming out. But the thing, it will be interesting to see how this moves over the next week or so, when we do have quite material opening up with restaurants being able to take 50 people. The question is really going to be about how comfortable people are to go out. So it's all very well for the government to open up, but if people remain concerned about the health issues, then they're less likely to go out and about. And if they remain concerned about their job prospects, they're less likely to spend. And as well, as I said before, we're starting to see an improvement in spending. So this chart here shows some ANZ card data. So we collect the data from people who are using an ANZ card to spend, or if a merchant has an ANZ terminal. It's all de-identified, and we get it in our economics area just into those sorts of categories that you can see there. So you can see the sorts of areas that have been very strong, like food retail is the orange bar, very, very strong, as there was a bit of panic buying and a bit of a shift to eating at home. That is still pretty solid at the moment, but not contributing so much. Fashion sales are very weak. Department stores weak, but then starting to look a bit better. And household goods looking okay. The black line is the total. Now, I would say that the overall strength is probably overstated, because a lot more people are using cards rather than cash. But the shape of the curve is what's important here, in that we have seen quite a material pickup through May in spending, and that is very encouraging. So just going on to housing now, which is clearly important, as I said before, for so many things in the economy, spending, housing, construction. So we expect that house prices will fall over the next 12 months or so. We're looking for a 10% peak to trough decline. So essentially, it's going to be an unwinding of the gains that we've seen over the past 12 months. There's three really main reasons for our thinking on this. The first one is the drop in jobs and incomes. The second one is the reduction in population growth that's going to reduce housing demand. And the third one is the difficulties around the rental market that are likely to reduce investor demand. So I'll just talk a little bit about the jobs situation. So for those who saw it, in April, the unemployment rate rose to 6.2%. But this is well below what the market was expecting, well below what we had expected. What happened is that employment fell by 600,000, but unemployment rose by only 100,000. So lots of the people who lost their jobs didn't look for another job. They either decided it was too hard or decided they needed to stay home and look after their children who were home from school, or any number of reasons. So that means they're not counted as unemployed if they're not actually looking for a job. So why I'm telling you this is actually, if they didn't stop looking for a job, the unemployment rate would have been 9.2%. So I think when we look at the unemployment rate, we have to be very careful about interpreting that, because it's really understating the actual hit to incomes in the economy, because of the fact that people aren't looking for jobs. Also, if you're on JobKeeper, you're counted as employed. So you might be at home and not doing any work. You might be going to work and working. But if you're on JobKeeper, you're employed. So you're not counted as unemployed. So once again, but your income might have halved. It might be down by 50%. But it will have quite a big impact on income. So we have to be really careful interpreting that. And that also, this sort of financial shock does tend to make people much more risk averse and much less likely to make a large financial commitment like buying a home. So that's the first reason. The next reason is population, and I've got a few charts there. The top left one is probably the most important. It shows the drivers of population growth. Those orange bars are net overseas migration. So they account for about 2/3 of our population growth. And obviously, population growth is a big driver of housing demand, whether that's for new houses or established houses. So the government expects net overseas migration to fall by about 85%, but it could fall even further. We do have some people coming home, but we also have some people leaving at the moment. And we have about nearly 2.5 million people in Australia that are temporary residents. They have temporary visas. Now, some of these people are eligible for JobKeeper. Some of the states have given special dispensation for some of these people, but a lot of them are just not entitled to any unemployment benefits, and those people might choose to go home. And that again would be a drag on population growth and a drag on housing demand. The next charts show some charts around the investor market. You can see here the issue with the rental market at the moment is that we've got an unfortunate combination of a big increase in supply and a big decrease in demand, both of which are putting downward pressure on rents. So an increase in supply from particularly from the short-term rental market, because of the lack of both overseas and domestic tourists. We're seeing this big reduction, and a lot of people putting their Airbnb type accommodation onto longer-term lease. As well, people who were perhaps potentially going to sell had difficulty selling because of the closure of the open houses and auctions, have put their properties onto longer term lease. And so what we've seen, particularly in the inner centres of Sydney and Melbourne, very large increase in rental listings, up sort of 35% over April. So very big increase in supply. At the same time, we've got a reduction in demand. Overseas students aren't coming. We've got a consolidation in household formation as share houses, incorporate more people so they can save on rent. And lots of young people who've been quite hard hit in this particular crisis have gone home to live with mum and dad. And so this combination of large supply, low demand has seen rents start to fall quite sharply. If you look at that bottom right-hand chart, that shows CoreLogic rents. They fell 0.7% in April, and that's by far the largest decline on record for this series that goes back to 2005. We also have the moratorium on evictions. So again, it just adds uncertainty for the investor market, and likely will mean that investors pull back from the market, at least in the short term. On the construction side as well, we think that we'll see quite a large decline in construction. Already we're seeing a collapse in new orders for construction that suggests building approvers will fall, and construction has already been falling since mid-2018. So what we'll likely see is a further fall over the next year. But what will happen is that because of the length of time taken to approve, particularly these large high-rise buildings, and then to build them, what's likely to happen is that once we get out to 2022, 23, we're going to not have enough homes, and then that will put upward pressure on prices and because of a housing shortage. We do think things will start to turn around, both for prices and for construction, in the second half of next year. But given that we don't expect unemployment to get below 7% until 2022, it's likely that housing demand is going to stay relatively subdued. Now, the next slide is my last slide, and it just shows a number of industries and where we think the pressure's going to be. So some industries we think over the medium term now will have some tailwinds, like manufacturing, given the issues around medical equipment in particular, but real concerns about supply chains in these crisis environments. Health, obviously, where there's going to be a need to build up and maintain some sort of crisis capacity. Technology, obviously, and defence, given the issues around geopolitics at the moment. And headwinds, obviously, tourism is, international tourism is really going to have a very difficult year until the borders open. Domestic tourism hopefully will benefit from the fact that people can't go overseas, but it's early days to see that. But I think, the crisis will actually have quite long-run effects on the economy, and that will be, very interesting in shaping what the recovery looks like. Now, I'm very happy now to go to any questions if you'd like.
Yeah, I'll put something up on the chat room.
Richard, yes, Felicity, Richard posed a question, which I'm just scrolling back to now. Is that given the enormous amount of printing of money, does this have a likely significant impact on inflation? And additionally to that, the stock markets seem to be performing so well. Could you sort of maybe give some insight on those 2 points? So printing of money and inflation and the stock market. Yeah.
Look, in Australia, we haven't really had quite so much printing of money. The RBA has taken quite a different approach to some of the other countries, and they are using this yield curve control. So they haven't actually bought that many bonds. In the US, they are buying lots of bonds, and in the UK, they actually did really, print money. They directly financed deficit. I think at this stage, though, it's really, no matter what your thinking is about quantitative easing, we have a problem with not enough inflation. Inflation targeting worked, and we got inflation under control, but the problem now is that there's not enough inflation, there's not enough wage inflation, and we actually would like a bit more inflation. So there's a possibility that all this stimulus will mean that inflation gets out of control, but that will help to pay us to pay off our debt. I don't really think there's so much spare capacity in the economy at the moment. When you look at some of the data coming out of China, production has picked up much more quickly than actual sales. So when you have a situation where there's more supply than there is demand, you have downward pressure on prices. So I don't really think that we're going to have an issue with inflation in the medium term. I think the problem is not enough inflation, not enough wage growth.
Yeah.
And the second question about the stock markets, look, I'm not an expert on the stock market. We don't really cover it that much, but it's been very surprising. When you look at the US though, if you take out those 6, I think, top IT firms, the performance is not so great. So it's really those technology firms that are largely driving the performance of the stock market. And clearly technology, like I showed in that last slide, is going to be a big winner, generally speaking, out of all of this. So I think that we're sort of getting a biased look at from the US stock markets in particular about the economic outlook, because those tech stocks are really dominating.
Thanks for that. Just one very quick point. America's printed or come up with $9 trillion. There surely must be a limit to the amount of money that you can create. No limit at all.
There's no limit. There's no limit. I mean, there's different ways to think about these things, but there is no limit. That if they choose, there are a lot of people now saying that governments will move to this modern monetary theory. Now, we're not quite at that stage now, but we are moving towards that. And that essentially means that the governments support demand in the economy by spending and manage the macroeconomy, much like the central banks have done over the past sort of 30 years or so, that it moves more to government spending. And these modern monetary theorists would claim that there is no limit, that the government can print money and spend that money, as long as they have control over their currency, as long as they don't have significant foreign currency debt obligations. So a country like Australia or the US could do that. And that is that, I mean, there are lots of arguments about this, but I think it's possible that we move to some sort of situation like that, where the governments are doing a lot more supporting, and either the central banks take these borrowings onto their balance sheets, which is what's been happening since the global financial crisis, or they move more extreme along to these other sorts of policy frameworks that mean that the government takes on the role of supporting demand in the economy.
Thank you for your insight.
Thank you, Richard, for that question. Now, we actually did have a few more questions, but I think we might come back as a Q&A. I think at this stage it would be great to actually hear from Bruce Gleeson, Principal of Jones Partners, Insolvency and Business Recovery, to give us his perspective on the economy and what's happening.
Thank you, Peter, and good morning, everybody. And thank you to BusyNet, Peter and Dimitri, for the opportunity to have you this morning. What I am going to do, because I'm following Felicity and she's given such a comprehensive economic update, I am just going to ask her in a moment, if she could, to share one of her slides, which I'm going to talk to, and it's the slide to do with the housing construction. So Felicity, in a few moments, could I maybe get you to share that, if that's possible? But look, let me talk about, firstly, one of the biggest myths that going around at the moment. When COVID first struck and it started to really sort of get hold, one of the questions that almost every person in insolvency and business recovery was asked was, you guys must be absolutely flat out. Now, the reality is that what I'm about to talk about is that that has actually been far from the case. whilst initially, and that might surprise a lot of you on this call this morning, but let me explain to you sort of what has happened there. So yes, it is true that when COVID first hit, the inquiry rate sort of spiked up a little bit. There's a big difference between the inquiry rate spiking up and then it leading to actual appointments. It's no different to you going to a car yard and looking at a car, but until you actually buy a car, we don't really worry about how many people are in the car yards looking at cars. So that has in fact been the case with what's happened in terms of the insolvency statistics. And if I take you through and I say, well, look, between the calendar or the financial years 2018 and 2019, there was actually a decrease in corporate insolvency activity to the extent of about 3%. And during that same period, there was a decrease in personal insolvency appointments by about 15%. What have we seen since July 2019 to around early to mid-March this year, just before COVID hit? What we've seen is that both the corporate and the personal insolvency levels have continued to deteriorate just a little bit. But certainly what's happened since COVID started is that ASIC and other government departments started to produce data on a weekly and fortnightly basis. And what I can say to you is that in terms of the corporate insolvency levels since COVID started, when we compare those levels to the prior year period, they have decreased by 35%. So they have literally fallen off a cliff. And to that extent, a number of firms in our industry have actually applied for JobKeeper and also made other sort of organisational changes as well. Now, let me sort of unpack that a little bit more and try and sort of talk to what's actually happening and what's likely to happen over the next little period. Firstly, what we've seen is that the government, and Felicity's covered a little bit of it, has thrown an enormous amount of stimulus at this problem. And many of you would remember early on in the COVID sort of crisis that the mantra was, we're building a bridge to get business and households through to the other side. So what we saw in the second stimulus package that was announced around the 23rd, 24th of March is that the government actually did a few things. And this starts to give us a bit of a clue as to why insolvency levels have fallen off the cliff. So what the government did was a few things. In addition to some of the moratoriums on debt recovery from the banks, most importantly, what it did is it said, well, if you're a business and you want to recover a debt from a customer, then two things happened. They increased the debt recovery threshold from 2,000 to 20,000, and they also increased the recovery time period from 21 days to 6 months. Okay, so if we just think about that for a moment, what that says to us is that if you're a business now and somebody owed you money at the time COVID occurred, or really went into sort of overdrive, then you're not going to be able to recover out on that until basically the end of September 2020. And also what the government did on the personal front is that it said for individuals that owed you money, that threshold was increased from $5,000 to $20,000, and the time period was also increased from 21 days to 6 months. So you can start to see that there was this common thread of kicking the can down the road or getting us across to the other side of the bridge. And also what happened is that the government said there's also a moratorium on insolvent trading for 6 months. So in other words, because of COVID, it recognised that if you actually generate a loss during that 6-month period, and then subsequently your business may need to go into some form of external administration, you can't be pursued for that period that you may have traded whilst insolvent. And I'm building the case here to say that we know, certainly our channel checks with the ATO show that notwithstanding that directors also became personally liable for for GST debts of a company from 1 April, that the ATO has also gone into basically a hibernation state and just isn't actively pursuing businesses or individuals that owe them money. Now, of course, we can all say on this call this morning, well, that makes perfect sense. That aligns with what the government's mantra has been, and that is to try and get us all through to the other side. But the reality also is that at some point in time, all of these debt deferrals are going to come home to roost. And so, you know, in terms of explaining to you, firstly, the myth that is there, insolvency activity has dropped off a cliff. When might it start to come back? Well, as Felicity has talked about this morning, certainly, you know, you'd expect the final quarter for 2020 in terms of the GDP results to be awful. And you'd probably expect that, you know, the first quarter in 2021 will be quite important for us to take a cue on as to how quickly we might sort of start to come out of, you know, some of the relaxation of the restrictions that have been imposed and what that might mean in terms of revenue flows back into businesses. In other words, how quickly that might occur. But importantly, you know, and I'll pick up on a point that Felicity made, and that was that they don't expect that the same level of activity will occur until 2022. So that means that we are on a slow recovery out of this. And if I said to you that there is a positive correlation between unemployment rates and bankruptcy levels, that is something that we are watching like a hawk, because, for example, what we do know is that during the GFC, there was an increase in the unemployment rate of about 1.75%. Now, at the time, that was said to be relatively mild in the overall scheme of what it could have been. But what we do know that followed quite soon after, and bearing in mind there is a slight lag period between this correlation I'm talking about, that there is a positive correlation between increasing unemployment levels and increasing bankruptcy numbers. So if this employment number continues to be up around the 7%, and it's likely that it's going to sort of move from 6.2 to a higher amount and then start to come down and stabilise. But I think what we are very likely to see, particularly given some of the points that Felicity has gone through, we will see an increased level of personal insolvency activity. There is little doubt about that. The question is, when will we see it? Now, I've talked to the fact that really the government has kicked the can down the road as far as the recovery actions that can occur. And what we don't know just at the moment too is what further adjustments or refinements the government might make to things like JobKeeper and other initiatives to try and get businesses through to, for example, the other side of this Christmas. I think the danger that we potentially have is that if it seeks to withdraw too quickly the stimulus that it's put into the system, then it may actually, and it's obviously working hard not to do this, but it may have a scenario arise where if it pulls the stimulus too quickly, then just before Christmas, there's a big collapse in confidence again. Now, I think there's a lot of lobbying going on by certain industry groups at the moment, and we're probably likely to see a little bit more targeted stimulus by the federal government, particularly around industries like tourism and the like. But we do need to wait and see what the next 1 to 2 quarters sort of reveal about that before I think we can take a bit more of a reasoned decision about where the economy might be heading in 2021 and what that means for corporate insolvency levels and personal insolvency levels. In other words, when they might start to rise. But for mine, what I'm watching like a hawk is the unemployment levels and this correlation that we know exists with the personal insolvency levels. That's the first thing. The second thing is, in terms of the corporate insolvencies dropping off a cliff, going to the points that I've made, we will see an uptick in that level of insolvency activity as well. But it will be a little bit of a case of who blinks first, because we've got the ATO basically in a hibernation state. We've got the banks quite rightly being very cautious about how they proceed in relation to any loan arrears and enforcement action. So all of that is likely to be many months away. Again, what we need to look at there is the impairment levels that the bank or the banks start recording. When we start to see any sort of material uptick in their impairment levels, that's when I think we'll start to see the banks will take a little bit more of an active enforcement activity. So what we are seeing, and Paul, I'll deal with your note in a moment. What we are seeing in the absence of formal corporate insolvency activity, we're seeing companies put their hand up and want to do a little bit more work on restructuring their businesses through safe harbour provisions and other more informal restructuring opportunities. But certainly it is the case that it's been suggested that there's a tsunami of insolvency activity to come. I'm not sure that I want to call it a tsunami just at this point, but I do see that there will be increased levels of both personal and corporate insolvency activity over the next period of time. Now, the point there simply is, if we watch those indicators, the unemployment levels and the bank impairment levels, that will start to give us a bit of a clue as to, when and how quickly it might come on. What I want to just talk to you all about this morning a little bit is on the corporate insolvency activity side, what do we know about that and why should we be worried about it? Well, what we do know is that roughly 80% of all corporate insolvency activity in Australia relates to small to medium enterprises. So that is generally enterprises that are employing up to 20 people. So you can see, and given the fact that small to medium enterprises are a significant economic contributor to Australia's prosperity, and I think sort of make up about 60 to 70% of the workforce, we need to also be looking at how healthy the SME sector is and how it's recovering coming out of COVID. Because it's true to say that a lot of SMEs, compared to listed companies and other big corporates, they generally, the one thing that they lack is they lack the resources to get them through periods of abnormal business operations. And really what we've seen at the moment is, and what we must all do, particularly advisors to business, we must help them come out of this survival mode, because if we just imagine what happened when COVID first hit, businesses and households went into this survival mode, and Felicity talked to the fact that so many households went out and bought as many toilet rolls as they could and so forth. There was just this panic response. There was this survival mode. What we've now got to do as advisors to business is bring them out of this survival mode and get them actually focusing on the next 12 to 18 month period. That's hard because when you're in survival mode as a business owner, it takes an enormous amount of energy. And that's why, from our perspective, we're very much saying to business owners, it's okay to put your hand up and ask for some help. You don't need to do it alone. And I think the danger at the moment is that there is just so much information out there. And many of you would have been like me in the early part of COVID. You're probably getting between 20 or 30 emails a day about government announcements, about what was happening. And it's probably fair to say that if you felt overwhelmed, then put yourself in the position of the average sort of small to medium-sized business owner. They were completely overwhelmed. So, we need to, particularly the advisors on this call today, and even the, ANZ in terms of its business customers, we need to do what we can to help them, through this period, because they are the engine room for the economy, and that is going to be a difficult next little chapter for them. What else I think I just want to focus on is that and I was actually brought a smile to my face this morning when I read that Disney World is going to reopen in July this year, and that sort of says to me that the world is starting to come back from this COVID crisis, and it is very much about the world in recovery, but it's going to be a long recovery. And so really this debt deferral that has gone on, the question for a lot of small to medium enterprises is if the path back for them in terms of a revenue piece is long and slow, can they actually get through to the other side? And I think that's where business owners do need to be quite pragmatic and be prepared to put their hand up and ask for some help, because there was something, and I'm happy to share it for people, share it with people that may want it after this webinar, is there was a very simple but powerful document that CPA Australia put out recently called the Roadmap to Recovery. Now, it's not an advertorial for CPA Australia. It's just simply to say it's a really clear picture as to the phases that we're going through. And it is also to say that if there is, a view taken that it might not be possible for a business or a household to move through to the other side, then let's actually have a conversation around what are the options and how do they, in those scenarios, actually plan then for the future? Because the longer, in our experience, that it's left, the more damaging it is to the person emotionally and also financially. So certainly from that perspective, that's what we're seeing at the moment. I would just caution, particularly again, those advisors that are on the webinar this morning, but also the business owners. Just because the ATO's gone into hibernation doesn't mean that it won't awake from hibernation at some point. And so against the backdrop that now directors are personally liable for pay-as-you-go, superannuation guarantee, now GST from 1 April, certainly at a minimum, please, lodge your business activities statements on time, even if it is that you can't pay them at that time, because you want to do all that you can to minimise or curtail any personal liability for taxes. So certainly that is something that I'd really sort of encourage everybody to do. But I read something earlier today also, and it's a little quote, but it's quite powerful. And it was simply this: revenue is vanity, profit is sanity, and cash is king. And so against that little quote, in this current climate, it is very much about businesses focusing on looking at their cash flow and being really pragmatic about it. And if that means that you need to really look at your customer base and look at making some fairly conservative estimates, what the customer recoverability might be, and indeed looking at the customers as to how quickly they might come out of COVID as well. All these things need to really be looked at. Now, whether or not you can do it yourself or you need some help, then that comes back to reaching out for help. I think there was a little pop-up I saw a moment ago that there is going to be a lot of people that we're going to see increased levels of mental health coming out of the financial distress that is caused. That's without doubt, there will be. And so, fortunately, there are many good avenues for business owners or individuals that may need to reach out and get professional assistance to do so. But it is something that we're aware of as advisors, and it's certainly something that we see all too often. I quite often tell the story, and in fact, to share with you a little story, I was getting a coffee from one of my coffee shops this morning, and I was having a chat to the owner, and I was just talking to them. I said, "How's business going?" And they said they're still 40% down. Now, admittedly, that's only coming out of a few weeks of more relaxed conditions, but 40% down is still significant. And we were talking about how quickly people are returning to work, and I think there's still a journey yet for that coffee shop to get back to before its revenue sort of starts to get back up to pre-COVID levels. And that's one example of what's happening out there. And so my message to some of you as business owners is make sure that you know what's happening with your customers, because that's key to analysing what the impact is going to be on your cash flow. And I think the other thing is too, if you thought you had a 2, 3, 4 or 5 year business strategy, you might just want to put that to one side just for the moment and focus on the next 12 to 18 months, because until we get through the next couple of quarters and start to see how we're going to all sort of land, I think it's really just important to focus on this next immediate period rather than getting too far out in front of ourselves. So I think that the final piece that I just would like to finish on, just in the interest of time, so there's enough Q&A, is to also leave you with this thought, and that is that there's very, very well-run businesses out there and really smart people that have already pivoted their businesses to adjust for changes in customer preferences during COVID. And if you're advising business or if you're a business yourself, you need to work out whether or not you've made those necessary adjustments, whether or not the business can make those adjustments. But it's clear that there'll also be some winners coming out of this, and we ought not lose sight of that. So, a good example being the civil construction industry. There is going to be lots of infrastructure work out there over the next few years. The governments of the day are going to make sure of that. And so it's not all doom and gloom. There will be industries, that will be able to do quite well out of it. Obviously, that's not to take away from the pain that some industries like tourism are suffering from, nor is it to take away from the fact that we have a sector being this, the retiree sector, that pretty much hasn't benefited from any of the stimulus that's been offered, but is going to feel it insofar as the lack of dividends coming through that they generally rely on from the shares that they have in a lot of the ASX listed companies anyway. So I think the key is in sort of closing off, and then I'm obviously happy to take some questions. Try and also ignore a little bit of the noise that's out there. I've said before that there was so much information going around in the early part of COVID that it was overwhelming, even for us that probably are used to digesting a lot of material. But I think it does also pay to reduce the noise so that we're focusing on the right things that we need to, either as professional advisors or business owners. Otherwise, you can read headlines and all the headlines do is scare you. So to that extent, I might hand back to Peter now. And if there's any questions, then I'm happy to try and answer those.
Well, thank you. It's what a fantastic commentary, and interesting that it actually ties in with what Catherine presented, with what Felicity presented to us. And there were some really interesting questions that were going around whilst you were both talking. We've had a couple of people leave us due to time constraints. So I might just throw the floor open a little bit whilst we've got some time. If we run a little bit over, I hope you can stay with us. But I think that they're good questions. You know, it's interesting. We have a lot of people in this virtual room today who are very much connected to the sorts of information which you have both talked to. We had a great question from Jill Lawrence. Now, Jill, are you still there? Yes, you're still there. So Jill is actually with the Australian Small Business and Family Enterprise Ombudsman. And her question was, you know, where can SMEs get trusted and affordable advice?
Yeah, it's a good question, and certainly, you know, what I would say as a starting point is that there's some good information on the moneysmart.gov.au website. That is a reputable and federal government site, and certainly is one that, depending on the business or the household sort of particular concerns, is a good starting point. Beyond that, certainly if it's around a financial difficulty question, then certainly, you know, advertorial for Jones Partners, we do provide individuals and business owners with a free meeting or Zoom meeting these days to really help them understand what options are available to them, and so that they can make an informed decision. And I make that point because there are a lot of dodgy advisors out there that basically will tell people what they want to hear and take a fairly big sort of fee for it. But sometimes it is also a case that you've got to really be pragmatic and help them focus on things that may sometimes be difficult for them to really make decisions alone on. And I'll give you one example just to illustrate the point. I had a chap sort of late last year. He was running a electrical business and it was hopelessly insolvent, but he could not bring himself, after having run it for 25 years, to make the decision himself. And so I actually said to him, because he mentioned his wife in one of our meetings, I said, can you bring your wife in the next meeting? And when we met, I explained to him, and with his wife in the room, I said, look, I looked to her and I said, what do you think needs to happen? And she said, well, I think he needs to exit the business. He doesn't have the mental sort of energy to put in it anymore. But he won't listen to me. And I said, well, that's what I've told him. But it seemed to simply be that once we'd actually had that level of communication with him, he was then able to move through and make that decision. And I think sometimes when we've had people in this COVID period in a survival mode, they almost get paralysed and are not able to make the decision themselves. So they need some help around that.
Thanks, Bruce. Can I pass over to Louise? She has a question for Felicity.
Thanks. Thank you so much, Felicity. That was a very great presentation. My question is regarding a second wave and whether you guys have forecast a second wave over the next few months.
Sorry, I'm going to go off mute. Look, when we did our forecast, we really thought that we would have had probably a more severe lockdown in the second quarter, but we certainly didn't, you know, we're not epidemiologists. We can't really forecast what's going to happen on the health outcome, and that's what made some of this forecasting very difficult, because it obviously was relative to that. But when we look at our forecast, we're not really incorporating that. We expect that things will look a lot better in the third quarter. And then, you know, as Bruce touched on, there's clearly concerns about what the December quarter might look like, given that so much of the government support at this stage looks to be removed. But we're not forecasting that there will be a big second wave, but we are incorporating this slow grind recovery because we don't think that people will be comfortable to go out and spend so much. So in a way, you know, we're sort of incorporating some sort of caution on the part of people. If we do get, I mean, and we will get obviously clusters, you know, we've seen with the schools in the eastern suburbs of Sydney that had to be closed down this week. We're going to get these little bits and pieces, but we're certainly not expecting a large second wave similar to the one that we had in March. And I think if that were the case, then not only would that lead to, you know, more lockdowns and closures and those sorts of things, it would also have a very big impact on confidence if we had a significant second wave and people had already started to go out, opening their businesses, and then find they have to close. I think that that would be mean that the recovery would be very much short-circuited, certainly in the short term.
And I guess if I could add to that, a comment by Elaine is that she in her business is seeing increasing levels of stress among her clients, and to go into a second wave would no doubt push that through the roof. I guess, Elaine, do you have anything to add to that?
Yes, thanks, Peter. So definitely I'm seeing that coming. So Bruce also bring that up just now during his presentation. And I guess there's something that I will encourage everyone who is right here in this chat right now, is that even for us to actually try to reach out to other people to help other businesses, also we need to even also take care of ourselves. Okay, I'm always somebody who always like telling each of us, you know, no matter what business you're in, whether you're in a business or you're as parents at home, we have to take care of ourselves. If we don't take care of ourselves, there's no way we can help others. So we always say that you can't pour from an empty cup. So we have to invest time for ourselves, look after ourselves before we can reach out to other people. And definitely I'm seeing more people having this like mental stress, and they're definitely so lost. But the thing is that when you're so lost in yourself, okay, and you have to start to acknowledge that I'm lost, you know, I need help. That's why we reach out to professionals, you know, to help us to solve the issue. But by all means, that, you know, first is always take care of ourselves first. Yeah. Thank you, Peter.
Thank you, Elaine. Now, there was also a dialogue going on in the chat between Lena and Richard Kirkby about population. You know, the comment was made in looking at Felicity's slides was, you know, the population growth has been from overseas has been significantly affected. And I suppose the questions that were being popped, or the statements were, you know, is that a good thing or is that a bad thing? I mean, clearly there's an argument both ways, but given where we're at, Felicity, did you want to comment on, you know, what's the impact of this sustained population growth from overseas being curtailed?
Well, I think that it will be, at this stage, it looks like it will be short term. The borders are likely to reopen with New Zealand and then probably sometime next year with the rest of the world, perhaps not until a vaccine is found. So we probably do need to think, policy makers need to think more carefully about the population policy framework. And obviously Morrison's comments yesterday around thinking about skills and skills programs, those sorts of things will be helpful. I mean, you know, in terms of the politics, it could go either way. You know, there was just, you know, a few weeks ago, Christina Keneally had that article saying, you know, we should use this as an opportunity to reduce population growth. But those are sort of more philosophical arguments. I think, you know, from the government's perspective and generally from business perspective, stronger population means stronger demand and healthy economy. I mean, it is worth saying that migrants tend to be more likely to be employed and tend to earn more on average than the locals here. So it does, you know, immigration offers enormous benefits for society, but then at the same time you have to take into account issues around infrastructure and the provision of that. So it's an opportunity for the government to reset if they choose to, but they would, if they choose to in the longer term move to lower levels of population, then that would obviously have implications for growth. I think, Peter, you're on mute.
Yeah, I do that to myself. In the interest of time, in concert with Dimitri, I wanted to say thank you very, very much to Felicity and to Bruce for what they've said. There has been lots of interesting conversation in the chat box, and there's been points of comment from Jill and Michael and many others as we've been through this. But I think we would, it would be appropriate at this stage to give everybody an opportunity to just very briefly say who they are and what business they're from, because I think that from Felicity and from Bruce's perspective, you get an idea. I mean, the content of what's been spoken to is so relevant to the businesses that are represented in this room. Dimitri, if that's appropriate, should we ask everybody to just introduce themselves?
Absolutely, Peter. Thank you. And
why don't you lead off?
sorry. Yep, thank you. Thanks, Peter. What I would like to say before we go ahead, I saw a message from Paul Sweeney saying that we are people, we still deal with people. So it's always a personal approach. So there is no such thing as a global market when you go into business relationships. It's also between one person and another person. So here we're trying not only to give you a valuable information with help of our great presenters, but also to make sure you get to know each other better. And what we are very happy to see with Peter, that we see that not only our members of the Chamber and members of the Business Alliance start working together more actively after those sessions, but we also see people from both organizations start communicating more frequently and actually put projects together. A couple of little things which help us to encourage you to do more networking during events and after the events. If you pay attention to the email we sent with all the links, there is a link to the landing page. Every event we run has got its own landing page with a list of all participants. So you can always find the name of that person, you can find the company name, and in the case with our members, Business of the Business Alliance, they all have landing pages. So those landing pages have got profiles of the company, profiles of the decision makers, links to their online applications, doesn't matter if it's social media or websites or videos or whatever. And from this particular event, we also decided to indicate in this list who is the contributor of BusyNet. So like, for example, Peter paid attention last night to this one new initiative. You can, for example, click on Bruce's link to his articles and see a library of, I think now over 30 articles about not only about business insolvency, but actually more about the recovery. Exactly the same with all other contributors. So you can get a big wealth of knowledge, get to know participants, guests and members at these events better through those links, and get in touch. So please do so. Don't wait. Or if you've got any questions, like there was a question how SMEs can find help and how to find great professionals. That's what we do, Peter and I, we do for a living. We get people connected. So we know our membership base, we know our great members really well. So if you've got any questions of any sort, they're always happy to help. So get to me or to Peter, ask the question, we'll help you to find the right person. And now I would like to start with our members, members of the Business Alliance New South Wales, and Bruce Gleeson, our gold member and partner in John's Partners Insolvency and Recovery. Please, guys, keep it short, maybe up to 30 seconds, so we can get through all of you and actually maybe even do a little bit of networking after that. So Bruce, please.
Yeah, thanks, Dimitri, and thank you for the opportunity to present this morning. Yours and Peter's comments about what BusyNet is trying to do, I fully endorse, and certainly with our business having offices in Sydney and throughout Greater Western Sydney, certainly we just want to be here to be able to help people that get into a spot of financial difficulty, whether they be a household or whether they be a business owner. We would just want to make sure they get the right advice and they know what their options are. So there's not, I could go into a lot more than that, but that is as simple as it needs to be. And, we recognise that nobody sets out to get into financial difficulty, but sometimes they just need to get help when they do.
Thank you, Bruce. The next one is Paul Sweeney, Pretium Solutions. Thank you, Paul.
Yes, hi, Paul Sweeney from Pretium Solutions. We're chartered accountants and certified business advisors, and we work mostly with small, medium enterprises, helping them achieve the business that they want. When you go into business, there are a lot of things happen that you don't expect or you're not aware of. Helping to give advice on how to run your business better, to make more profits, to achieve those things that are important to you, and working with a team of advisors. It's not a solo thing. You need more than just a good accountant. In this process, you need a good team behind you as a small business. So Bruce mentioned that small business owners don't have the resources, and that's where advisors working together proactively can really make a big difference for small, medium enterprises.
Thanks, Paul. Silver member of Business Alliance New South Wales, Lynn Fisher from Promtel.
Oh, am I unmuted?
No, yes.
No? Hi, everyone. My elevator speech is that I put things into boxes really, really quickly. I have a 3PL warehouse. I store, look after, pick, pack and ship goods for retail customers generally. Our challenge at the moment is that people aren't spending in the stores of our clients. So we have hairdressers and we have beauty salons as our main clients, and whilst they will be allowed to open again soon, yes, that's great, people aren't really spending their money in them as much as we had hoped. So yeah, it's a bit of a challenge. So very, very on point discussions today, and lovely to meet you all. That's me.
Thank you, Lynn. Grace Won, Connect mobile apps.
Yes, good morning. My name is Grace. I'm the founder of the Connect mobile apps. So basically, I'm the mobile apps founder, developer, and I'm obsessed with the crafting of beautiful apps. So basically, I will develop a mobile app that will be uniquely yours, and to help you to grow your business, save your money, and save your time. Just Grace from Connect mobile apps.
Thank you, Grace. Aline Yo from from Yin Latte Yoga.
Hi everyone, thanks Dimitri, thanks Peter. Hi everyone, nice to see you again. And yes, my business is Yin Latte Yoga, and I'm a yoga therapist and a Yin yoga teacher. So what I'm doing is that I'm actually helping my clients to, or more like educate them, give them some information and just guide them along the way in terms of how they can manage their health, especially when they have chronic issue like, chronic stress and chronic pain. That's where I come in to actually give them some technique of yogas and actually helping them to manage their stress and pain as they move along. So it's like giving that power back to them. Yeah, and definitely, for my one advice for everyone today right here is that please take good care of your health. Your investment will be your health. That is one message that I always telling people. Please take care of yourself. Please, please, please. Okay? Thank you, Dimitri.
Thanks very much, Elaine. That's all with Business Alliance New South Wales members. So Peter, get back to you.
Thank you, Dimitri. Elaine's just making me feel guilty for not attending her video classes, but I will at some stage.
He always does it with us.
I know. I'd like to introduce Catherine Poblete from ANZ. Catherine, say hello.
Good morning, everyone. Thank you so much for organising. This was really relevant content, and in terms of my role in the bank, I have a portfolio of commercial clients, and my role at this time has been quite challenging. And our focus is to help our customers and work with their advisors to get through this, because the best thing everyone can do is try and get out the other end. And I just think in terms of the recovery, and there is a lot of negative news, but there is a lot of positivity. A lot of my clients are based in the CBD, and they come from a wide spectrum, and it's really around just keeping those communications open. So thank you so much for everyone being involved in this. It's really relevant information and quite pertinent right now.
Thank you, Catherine. Michael Perkins.
Thanks very much, Peter. I'm Michael Perkins. I'm the founder of Autonomy First Lawyers. I'm a third-generation private client lawyer, and we work across small and medium businesses as well as families and the community issues around ageing decision makers. We've just started with MQ Health, a decision support and capacity evaluation clinic at Macquarie Hospital. And we're finding quite a lot of interest from community and family and GPs around dealing with the consequences of people having trouble with decision making. So we are collaborators across the governance, shareholder, family wealth conservation and administration and succession. Yes, and we also do wills and stuff. So that's me.
Thank you, Michael. Jay from Providence, I'm sure very interested in the property forecast. Say good day.
Hey guys, yeah, it was great. We actually presented with Felicity in March at ANZ's head office, which seems like a lifetime ago now, because we would never get in a room with that many people today. And she always does a fantastic job. Her insights are fantastic, so thank you. Insolvency is also really important, so thank you very much for the contributions there. So we're a buyer's agent. At the moment, our challenge is obviously the inquiry has, well, not inquiry, the amount of clients wanting to do something has dropped, but inquiry is still very much there. There's a lot of negativity, but we're seeing people buy properties well under what they were selling about 4 months ago. And a lot of people don't remember that the market has been on a tear. And as Felicity mentioned, we may lose the gains that we've gotten, but we got an amazing amount of gains in less than 12 months. So for us, the majority of clients we're dealing with are those people that are in the camp of financially, they haven't been too affected by what's going on at the moment, and they're very optimistic, they're opportunistic. So those aren't difficult clients to deal with. The clients that are difficult to deal with for us at the moment were the ones that are in the camp of they get scared easily, or they've heard a lot of negative news or media, and they've gone, I'm just going to hold off and not buy. My question for those people are always, if you have to wait to do something once positivity has come back to the market, you're probably too late. So it's a very fine line of trying to negotiate when's a good time to get in and when's a good time to stay out.
Good words. Thank you, Jay. Helen, are you still listening to us? Helen Fraser from Ultimately Sydney. Helen's being distracted. She's probably running a virtual tour at the moment. And recently just joined member Charles Estefan. Say hello.
Oh, hi, Peter. Thanks. Thank you for the invite today. It's been fantastic being a part of it. It's great insight from Felicity and also Bruce. Enjoyed that. I'm an architect and a builder. My company is called Architect Projects. So I do everything from office fit out to new build residential construction. At the moment now, working with some clients, doing some affordable housing, some boarding house stuff. Obviously with the financial climate the way it is, trying to give back to the community in whatever way I can. So coming up with some affordable housing sort of solutions and some disabled. But I definitely would probably like to touch base with the Providence property to see who he's got interested in buying, because I also do some property development as well.
Great connections. We love that. Richard Dubb, say a few words.
Hi, everyone. My company is Richard Dubb, Consulting and Coaching Services. As you all know, it can be very lonely at the top. And my role is to actually find the hidden value in your business. I provide a fresh pair of eyes, and I charge only on positive results. So give me a call, cost you nothing to have a chat, and see where we go. Thank you.
Thank you, Richard. Michael, are you going to say a few words? You have to turn yourself off mute.
Oh, can you hear me now?
Yes, we can.
Thank you. Look, this has been an amazing experience. This is my very first Zoom, so I hope I've been behaving myself. I'm a photographer. As you probably see, I've been taking pictures all this morning, and I've been in the business for a long time.
All been photographed whilst on Zoom by Michael. Look at that.
I do a lot of events when they're on. I also do a lot of corporate work, and I also have a very busy Instagram. Michael_Thompson_photography. So if you want to see my stuff, have a quick look. And my phone number is 0407 330 347 if you need a chat.
Right.
I'll repeat that, 0407 330 347. Thanks, Peter, for the opportunity. And everybody else, it's been wonderful meeting you all. Thank you.
Thank you, Michael. Show us your reel later. Helen, are you with us, or are you going away? Now, Helen would have been interesting to say hello. Helen is one of the groups from the slides that has been significantly affected in terms of travel and tourism business, but unfortunately she's not there to say hello. So that's everybody. Did anybody have any questions or discussion points that they'd like to ask of anybody in the room?
Peter, Michael Perkins, just a reminder, following the last meeting for everyone that I think this is a very valuable experience, and in the spirit of collaboration, let's all try and invite one or two guests to the next one of these, because I think the more the merrier, and the better the exchange of views we have, I think the more impact we have.
Thank you, Michael. And I must say that I've completely ignored Jeffrey because he disappeared off my screen temporarily. Jeffrey Choi, say hello.
Hello, everyone. It's been a really interesting talk today, and I've got a lot out of it. My business is JCL Legal. I deal with asset protection for people and businesses by drafting documents and by litigation. And I believe that as we've all been talking about here, it's conversations between each other that help us get the results that are most profitable for a win-win situation. And I look forward to much more meetings as we have today.
Thank you, Jeffrey. And Helen Fraser is back with us. Helen, say hello.
Hi, everyone. My apologies for that. I had an issue here at the time, at that moment, so I took myself off the screen. But what a wonderful presentation. Thank you. Lots of information. Should be very scared. I work in tourism, and yes, things are very, very low. But I just sent out, I don't know if anyone follows me on LinkedIn. I sent a really positive article this morning talking about how we are post-COVID ready, and the 5 key strategies that we've implemented to make sure that people are very comfortable and safe to travel with us, because we've got a fleet of vehicles out there that are all carrying nice leases. I always started my business without any debt. I made money, then built and made, built, made and built. And now I've got myself to this very high profitable business with the best profits last year, and this year paying huge tax on it. Can you believe it? With no income. Oh my God, this was so not what I wanted to be, where I want to be, but I'm taking it as a massive opportunity to build the domestic industry market. And we've got lots of fun things on the table. So wish me luck.
Thank you, Helen. And it's one thing I'd encourage you all to do. Go to ultimately-sydney.com.au, and you can do it at any time and take a virtual tour. And so you can, we all can't go on holidays, but you can take a virtual tour with Helen. Last week we were in the Hunter Valley. It was great. Thank you, Helen.
Peter, Peter, we totally missed Louise McKinnon from Carraggio.
Louise, sorry, Louise. My screen is obviously letting me down. Say hello.
Don't worry at all, Peter. I was about to jump in anyway. Thanks, Dimitri. Again, thank you to the presenters. It was fantastic. And Carraggio is a peer-to-peer advisory board service. So you can imagine the hundreds of members that we have at the moment are really coming together as a community. And what I've certainly seen from the business owners that are part of Carraggio is the encouragement, the time they're giving to each other, the deep listening and the support, not just from the chair people, but the tiger groups that have been set up within each of the boards has been phenomenal to see how much business owners think about their smaller suppliers, how they're thinking about their employees, how they're thinking not just about themselves and their cash flow. It's been a huge experience and a huge learning curve for all of these businesses, but together they do feel that they will survive through this. So it's Louise from Carraggio, and if anybody wants to have a conversation, I'm very happy to have it. Thanks.
Thank you, Louise. And I've also neglected to introduce Omar Afioni from MAP Institute, but he's there. He's not. Not to worry.
Peter, we also have got Jill Lawrence from Australian Business and Family Enterprise Ombudsman.
I'm going to give up doing these introductions, Dimitri. I think you're much better at them.
I've got the list. There is a landing page with all the names on it.
Good morning, everyone. Thank you, Dimitri. Jill from the Australian Small Business and Family Enterprise Ombudsman's Office. I'm a team leader in the advocacy team. My interest this morning was insolvency. We're about to conclude our inquiry into insolvency. And the key challenge, and I think it was spoken about in the chat and by our presenters, is the emotional aspect. Small business owners, it's their life, it's not just their business. So when they're struggling, they can't see that. And they're not just giving up a business, they think they're giving up their life. So finding that trusted advisor, keeping out of insolvency is their passion. Not losing their business is their passion. And I very much take on board the need to, Bruce, as you say, the example you gave was exactly what the average small business owner is dealing with. And things like safe harbour are not usable at the micro end of small businesses. Voluntary administrations are not usable. They're legalistic, they're expensive, and they go to Google and find some really scary people. So it's been wonderful meeting up the group here. There's obviously incredibly nice people, trusted advisors, and it does restore your soul that there's people out there willing to help small business owners. Thank you very much.
Thank you, Jill. And we've got a couple of guests here with us. Matthias Koop from, Matthias it's his second meeting as a guest, so could you please say a couple of words? Matthias, please.
Thank you very much, Dimitri, for giving me the opportunity. It was a great presentations. Really enjoyed them and gave me lots of new insights. So I represent 5-4 Capital, and 5-4 Capital is a non-bank lender specializing in cash flow funding solutions to small to medium-sized businesses. So I see directly what's happening in the market out there and to what extent businesses are suffering from the current crisis. And I feel very passionate about it because I've been myself as a business owner of an electrical contractor in their situation before. So we are a large organization and we are very fast, nimble, and flexible, and support businesses during these times. That is important to say from my perspective. Thank you.
Thanks, Matthias. And also we've got another CBD Sydney Chamber member, Gillian Gu from Cubic Promote.
Thanks to nice to meet everybody. I'm here for Cubic Promote, also Ava Safe. Want to actually share a very interesting aspect of the business during COVID-19 is Cubic Promote used to supply branded merchandise for corporate business, small to medium to large, with the branding. During the COVID-19 though, nobody's promote their business, nobody need the merchandise. And we actually shifted the business from all sorts of merchandise to one product, hand sanitizers. And therefore we got Ava Safe born, which we supply all the workplace safety solutions from hand sanitizers, face masks, to thermal crowd cameras that detect people's forehead temperature. And further, we got sanitizing solutions to decontaminate your workspace. So yeah, this virus situation actually shifted our business direction from merchandise to safety solutions. So yeah, that's what we do. And thanks for the time. Thanks, everybody.
Thank you, Gillian. Yeah, just now I think we can ask our members and guests to ask questions or maybe share their concerns and what they would like other business people to know. Networking.
Look, I'll just jump in. I will need to jump off now. I have another meeting to go to. It's been great to hear all your stories about your businesses, and thank you very much for your questions today. And hopefully I'll see you at some stage in the future, perhaps face to face. So thank you very much for organising, Peter, Dimitri. It's been great.
Thank you. Thank you, Felicity. And you know, it was just, I think, a really informative presentation. I've got a list of at least half a dozen questions I'd like to ask you, but not today. Maybe next time, face to face.
Okay, great. Thank you. Thank you.
Thank you very much. Bye-bye. Okay. Now, Dimitri, can I say something just while we're talking about questions?
Please.
Good morning, everybody. One of the things we're keen to do as we look to develop this series of discussions is to get feedback. So we've actually developed a little feedback form, which is on the link that you would have received with the email with the link to this discussion. I think that's the easiest place to find it, is it not, Dimitri?
Yes, yeah, on that link.
Yep. So you get a link to the event. There's also a link to the participants in the event, and there's a third link, which is actually a link to a survey. We would really appreciate it if, whilst we're just talking among ourselves, if you could open that link and complete the survey for us, and that will be very useful to us. And Gillian, I have to apologise for not having introduced you, because I didn't recognise your email because I was looking for Cubic Promote, and you have Ava Safe there, so that's what tricked me.
No, that's all good. Thanks.
Does anybody have any general discussion questions?
Sorry, Peter, and I just sent a link to everyone in chat with that to the page with the survey.
Great. So it's an anonymous survey. You don't have to put your details in it. We're just generally looking to get feedback. If you want additional discussions, then yes, tell us who you are. Thank you very much.
Maybe I can start with a general thought. We're always thinking with Peter how to raise the most important and critical issues. And one of the things I'm thinking for years actually about, and sometimes we're successful, sometimes we're not, we are all here sitting business people. We've got clients, we've got networks, and some parts of those networks, they're well recognized, highly respected, and knowledgeable business people. So the question is, how can we activate our personal business networks into a benefit of the whole network in general? It's a big question to ask. We do some action sometimes to actually activate it and get it done. And imagine if at least 5 or 10% of each one of us network would be engaged in our general network, how much of a new benefit we all could get as a network and individually as well. So yeah, the question is how to get our personal networks activated.
I'll just raise one point. Because of the speakers that were very, very good, one thing I've come across which I find very, very surprising are the number of companies that don't have cash flow forecasts. It's quite amazing to me that they've got budgets, they've got their strategies, but they don't every month show a change in their cash flow forecast. And particularly in these times when they've suddenly found that they're running out of cash and no idea where they're going in the next couple of months. I just raised that point for the other people who help companies. It's something that I think is really important.
I fully agree with you, Richard. That's one of the big things that business owners ignore completely is they don't take a close look at how much cash they've got available, how much cash is coming in. They don't look at their forecasts. They don't look at their sales. They look at what they're doing at the moment and whether they can invoice it, but they don't look at how quickly they're getting paid. They don't look at what the pipeline is of future sales, and the pipeline management is going to be critical. We're all talking about this period through to the end of July, but the period we need to start looking at is what's going to happen after that period, July through to December, managing that pipeline, but also forecasting, you know, how much cash are you burning on a monthly basis or a weekly basis, doing the essential things of your business, and what stores do you have available. You can only tell that through forecasting. It's not a perfect situation, but having some good knowledge is better than no knowledge at all. And once you've got figures available and forecasts, you can see where you're going. You've got the information there to make an informed decision. So yeah, cash flow forecasts are critical at this time. They're critical for businesses in general. You shouldn't, you know, cash is one of the most important KPIs to measure in your business, not just how much you've got, but how quickly are you turning it over.
Can I add something to that as well? I've been dealing with a lot of clients in trying to recover outstanding invoices, and I've been taking a very much collaborative approach, and I've found that a lot of small business people don't even have the metrics. They don't have, and I use an Excel and Xero, and I have but I found that a lot of the debtors were saying to me, well, look, we can't afford it. And my response is, have you got JobKeeper? No, we haven't. I say, why haven't you got it? Well, I can't prove that last year's figures and this year's figures there's a discrepancy. So there's a basic lack of having basic knowledge, basic metrics about businesses. And because a lot of small business people work in it all the time and forget to work on it. And that is one of the most important things that we've got to, as a group, impress on our clients, that they have to have those metrics. If you don't have those metrics, you don't even know where you're going. Cash flow may be great, but profit might be negative. So just looking at cash flow really doesn't tell a status of a business, in my opinion.
No, you need to look at both cash flow and profit, but you can make a lot of sales and have cash flow coming in, but if you're not making a profit on it at the same time, at some point you're going to have to inject cash from somewhere else, and that's got to come from lending or borrowing, or you're drawing down on your personal funds. So you need to, you can't look at cash flow or profit separate. They both work together. They're both foundational, but you need to know. And you touched on using Xero. Xero's building a whole bunch of KPIs and dashboards in there so that a business owner can know, and I know that other accounting systems are doing it. It's those business owners that don't track their record keeping, don't track their sales or their profit or their cash flow, that are really struggling and don't have the resources available to take advantage of JobKeeper at the moment.
Yeah. And Paul, I've got a question for you. Maybe it's a silly question from someone who never touches any accounting software in his business and all of that, but what tools would you recommend for a business owner to use to make it like make this information available in simple in a simple scenario?
The no-brainer is you've got to have an accounting system, and Xero and QuickBooks particularly are probably the leaders in Australia in making accounting systems that are available that are designed for the business owner, not for the accountant to use. So they've made doing this very simple. They use automatic data feeds of your bank information. Invoicing is easy, reconciling, getting the reports out. They've made it so simple. And this, you know, a lot of business owners will balk at the subscription saying $50 a month is too much. Well, $50 a month is not enough. Like, it's a small price for knowing exactly where you're at. You know, you don't want to get it to a situation. If you get to a situation where you've got no cash flow, you've got to go to the bank, but you've got to have the figures. So how do you create the figures? You've got to know what your figures are, and an accounting system is the basic of that. You've got to have it. And you know, Xero, QuickBooks, those guys have made it so easy for a business owner to manage their, to at least track their finances. You know, understanding the figures, well, that's where we come in. That's what we help in terms of what the figures are, where you should be planning, what you need to fix, identify. But your accounting system is a basic part of it. And like I said, they're designed now for business owners. They're not designed from the accounting point of view. They're designed to be easy to use.
And is MYOB the same?
Not my favorite product. Look, when MYOB came in, I loved it because it was the first package designed for small business. But the reality was it was written from the accountant's point of view, not the business owner's point of view. And I think moving forward, they've still kept that basis. And that's why my preference is definitely for somebody to be using Xero or QuickBooks, because they are designed for the business owner. You know, as a business owner, you don't want to be spending your time doing accounting. You want to be working on your business, making sales, running your business profitably. You don't want to be doing, you didn't go into business to be an accountant or a bookkeeper.
Correct.
Dimitri, I just agree with Paul, but just to give you an illustration, some months ago, I came across a company helping them, and they're big, quite a big company, and no idea of their cash flow, and they were going to go bankrupt. There was no question in my mind. They were going to totally run out of money. They had absolutely no idea that this was the case. And I cannot stress and agree with Paul how important it is to have that information.
I have to put a disclaimer, sorry. It doesn't mean that we don't look into those things. I've got someone who is taking such a good care of all our finances. So it's all in order, it's all good. I'm just asking as a person who doesn't do much of an accounting and bookkeeping in my business. So yeah, sorry.
Okay. So how are we all looking for time? We're now at just past 12 o'clock. I think Louisa's going to take off. Michael's got to take off. I think we were happy to call it for a day. It's been a thank you very, very much for everybody who's participated and contributed. It's been a great session. Really appreciate both presenters' discussion. And what I did want to mention to you was that in 2 weeks' time, we're going to have a guest speaker on the whole issue of cyber security, which is, of course, very, very much on the increase in terms of cyber threats at the moment. And we're going to have somebody look at that from the legal side of things as well. So we're looking forward to that presentation.
Peter, it's Michael. I just want to say thank you very much.
All good. Thank you, Michael.
Thank you,
Dimitri?
Yeah, thanks everyone. And it was another great session. So, and Peter, would you like to mention our challenge? We've got not too many people left, but challenge for the next month.
Yes, our challenge. Our challenge is, as Dimitri hinted upon, we want, we get a great amount of advocacy from folk who attend both this session plus the one on Tuesday, but we really want to grow it astronomically in terms of inclusion. So we're asking everybody next time they come to one of our events to invite a friend, and if you would do that on an ongoing basis for the next 3 to 4 weeks or more, we suspect that we will be able to treble the amount of people with whom we can engage in these virtual discussions. At some time in the future, we hope to be able to front everybody face to face as well. But in the interim, we would really like to expand this group. And I think we can all see that there's great content, there's good contribution, there's great conversations, and we would encourage you to do that. But all you have to do is just invite one more person next time. So we had over 32 people registered for today's event, which was fantastic. We'd love to do it with 64. Thank you.
Well, thanks, everyone.
Have a great day. And by the way, the stock market has peaked over 6,000. So clearly what we've been talking about has been a great stimulus to the economy. It'll go down tomorrow though, don't worry. So have a great day.
Paul,
Thank you.
Paul's gone.